We begin with Opendoor's Q1 2026 earnings announcement, focusing on the acceleration of market share and resale velocity beyond the October results. The company achieved its largest acquisition contract quarter since 2022, with resale margins improving month-over-month since September 2025. Notably, the March 2026 figures delivered a higher contribution margin. Furthermore, aged inventory has decreased to 10% from 51% in Q3 2025, and both the Q4 2025 and January 2026 cohorts represent the best cash acquisition cohorts in Opendoor's history. This indicates Opendoor is EBITDA profitable on a 12-month forward basis, and that the Q4 2025 and January 2026 cohorts exhibit the best combination of margin stability, and resale velocity in the company's history, excluding the COVID-era cohorts. The October, November, December of 2025 and January 2026 cohorts are selling at a pace not seen since 2022, with aged inventory significantly reduced. Consequently, the resale contribution margin is at its highest level in nearly 2 years. This trend is not accidental. It signifies a structural shift towards better acquisitions, faster turns, and stronger margins, demonstrating the successful operation of Opendoor's current business model. This data suggests a continuously improving financial health for Opendoor and sends positive signals towards achieving its profitability objectives. This slide outlines the company's management objectives and their execution status. The first objective is scale acquisitions, with home purchases increasing by 45% from the prior quarter. Acquisition contracts in Q1 2026 exceeded 5,000, doubling the figure from Q4 2025 and reaching the highest level since 2022. Regarding the second objective, improve unit economics and resale velocity, the percentage of homes on the market for over 120 days has declined from 33% to 10%, which is lower than the overall market average of 33%. Furthermore, the contribution margin has improved monthly since September, with March 2026 showing the highest contribution margin since Q2 2024. Notably, the October, November, December, and January 2026 cohorts are selling faster than any corresponding cohort since COVID. The third objective is to build operating leverage. Fixed operating expenses were $33 million in Q1 2026, a $2 million decrease quarter-over-quarter from $39 million in Q1 2025, and a $6 million decrease year-over-year. Trailing 12-month operating expenses as a percentage of revenue remained stable at 1.3% quarter-over-quarter. This slide presents the company's financial performance. Firstly, for the quarter ended March 31, 2026, revenue decreased by $433 million to $720 million compared to the same period last year. Gross profit fell by $27 million to $72 million, and the gross margin declined from 10.0% to 8.6%. Net loss widened by $88 million to $173 million. Homes sold decreased by 1,025 units to 1,921, and homes purchased also fell by 1,135 units to 2,474. Homes in inventory at period end increased by 3,660 units to 3,420, and inventory also rose by $1,223 million to $2,362 million, indicating a growing inventory burden. Homes under contract to purchase decreased by 888 units to 1,051. Looking at the non-GAAP financial highlights, contribution profit decreased by $22 million to $32 million. Although the contribution margin slightly increased from 4.4% to 4.7%, adjusted EBITDA decreased by $1 million to $31 million. The adjusted EBITDA margin improved from -4.3% to -2.6%, while the adjusted net loss increased by $14 million to $49 million, suggesting a need for overall profitability improvement. Let's look at the Q2 2026 financial outlook. Regarding acquisitions, you can track our acquisition contracts on accountable.opendoor.com, and we expect revenue to grow by approximately 25% quarter-over-quarter. Our contribution margin bottomed out in September 2025 and has been improving every month since, with expectations for Q2 2026 to fall in the middle of our 5 to 7% targeted contribution margin range. Adjusted EBITDA is expected to be break-even for Q2 2026, plus or minus a few million. You can continue to follow our progress on home acquisition contracts and product and feature launches every single week at accountable.opendoor.com. This slide presents the quarterly financial highlights and operating metrics for Opendoor Technologies Inc. as of March 31, 2026. Looking at revenue, it decreased slightly from $736 million on December 31, 2025, to $720 million on March 31, 2026. Gross profit increased from $57 million to $72 million, consequently improving the gross margin from 7.7% to 10.0%. However, the net loss significantly improved from $1,096 million to $173 million, though it still remains a loss. The number of homes sold slightly decreased from 1,978 to 1,921, while the number of homes purchased significantly increased from 1,706 to 2,474. Homes in inventory grew from 2,867 to 3,420, and total inventory increased from 925 to 1,139. Notably, the percentage of homes on the market for over 120 days dropped sharply from 33% to 10%, indicating a faster inventory turnover. Under non-GAAP financial highlights, contribution profit increased from $7 million to $32 million, and contribution margin significantly improved from 1% to 4.4%. Adjusted EBITDA loss narrowed from $43 million to $31 million, and the adjusted EBITDA margin improved from 5.8% to 4.3%. Finally, the adjusted net loss improved from $62 million to $49 million, showing an overall positive trend towards financial improvement alongside improved inventory turnover. These figures suggest a company actively managing its inventory and showing signs of financial recovery. This condensed statement of operations outlines the company's performance over specific periods. Observing the revenue, we see fluctuations starting from $720 million, moving to $736 million, then $915 million, a significant jump to $1,567 million, and finally a decrease to $1,153 million. The revenue decline in the last period is particularly noteworthy. The cost of revenue constitutes a substantial portion of revenue and tends to move in line with revenue changes, leading to the gross profit, which ranges between $72 million and $99 million. Operating expenses represent direct costs of business operations, including sales, marketing, general and administrative, technology development, and restructuring costs. Total operating expenses show a decreasing trend from $231 million to $155 million, suggesting improved efficiency. The net result of these revenue and expense dynamics is the loss from operations, which spans from a $159 million loss to a $13 million loss. Other income and expense items, such as gain or loss on extinguishment of debt, interest expense, and other income, net, collectively impact the pre-tax profit or loss. Ultimately, the net loss, including the $85 million in the final period, indicates continued periods of losses. The net loss per share demonstrates volatility, increasing from 18 cents to $1.26 due to declining profits, before decreasing again to 12 cents. The weighted average shares outstanding have gradually decreased from 959,332 to 723,542, which could be attributed to factors like share buybacks or capital reduction. Overall, This statement reveals efforts to improve profitability through revenue fluctuations and operating expense control, yet it also highlights persistent losses in certain periods. This balance sheet presents the company's assets, liabilities, and equity as of March 31, 2026, and December 31, 2025. Looking at the assets, total assets as of March 31, 2026, amounted to $2.349 billion, an increase of approximately $42 million from the previous quarter. Notably, cash and cash equivalents grew by about $37 million to $999 million, and real estate inventory surged by a significant $214 million to $1.139 billion. Conversely, restricted cash and escrow receivables saw a slight decrease. This indicates not only an increase in cash holdings but also a rise in the volume of real estate transactions, which is the company's core business. Next, total liabilities and equity equal $2.349 billion, matching total assets. Current liabilities decreased by $9 million to $317 million from the prior quarter, primarily due to a $27 million reduction in accounts payable and other accrued liabilities. Non-current liabilities remained relatively stable at $1.078 billion. Shareholders' equity stands at $954 million, a decrease of $111 million from the previous quarter, mainly attributed to an increase in accumulated deficit by $1.73 million. Overall, while the company's asset size has grown, shareholders' equity has shown a declining trend, which warrants careful consideration from a financial health perspective. This slide presents a comparison of cash flows for the 3 months ended March 31, 2026, against the same period in 2025. Operating activities show a net loss of $173 in 2026, an increase from $85 in 2025. Adjustments to reconcile net loss to cash include depreciation and amortization decreasing to $8 in 2026 from $10 in 2025, stock-based compensation increasing significantly to $120 in 2026 from $14 in 2025, and inventory valuation adjustment decreasing to $9 in 2026 from $13 in 2025. Changes in operating assets and liabilities indicate a decrease in escrow receivable by $6 in 2026 compared to a $14 decrease in 2025, and a decrease in real estate inventory by $221 in 2026 versus a $212 decrease in 2025. This suggests the company is managing its working capital effectively. Consequently, net cash used in operating activities was $246 in 2026, a slight decrease from $279 in 2025. In investing activities, purchases of property and equipment amounted to $4 in 2026 and also $4 in 2025. Proceeds from sales, maturities, redemptions, and paydowns of marketable securities were nil in 2026, whereas $6 was generated in 2025. Therefore, net cash used in investing activities was $4 in 2026, a reversal from the $2 inflow in 2025. Financing activities show proceeds from issuance of common stock for ESPP at $1 in both 2026 and 2025. Proceeds from non-recourse asset-backed debt significantly decreased to $68 in 2026 from $576 in 2025, possibly indicating a shift in funding strategies. Principal payments on non-recourse asset-backed debt were $53 in 2026, compared to $362 repaid in 2025. These financing activities resulted in net cash provided by financing activities of $16 in 2026, a substantial drop from $207 in 2025. The net decrease in cash, cash equivalents, and restricted cash was $234 in 2026, compared to $70 in 2025. The cash, cash equivalents, and restricted cash at the beginning of the period was $1,301 in 2026 and $763 in 2025. Finally, the ending balance of cash, cash equivalents, and restricted cash stood at $1,067 in 2026 and $693 in 2025. Overall, the cash flow in 2026 shows an increasing outflow from operating and financing activities and a decrease in inflows compared to 2025, leading to a reduction in the company's cash reserves. This table presents a reconciliation of our adjusted gross profit and contribution profit to our gross profit, which is the most directly comparable GAAP measure, for the periods indicated. All figures are in millions of dollars, except for percentages and homes sold. Looking at revenue first, we see an increase from $720 million for the 3 months ended March 31, 2026, to $1,567 million for the 3 months ended June 30, 2025, with $1,153 million for the 3 months ended March 31, 2025. Gross profit, GAAP, follows the trend of revenue growth, but the gross margin decreased from 10% in the March 31, 2026 period to 8.6% in the March 31, 2025 period. This is because items such as inventory valuation adjustments are factored in before calculating adjusted gross profit. The inventory valuation adjustment for the current period increased from $9 million for the 3 months ended March 31, 2026, to $21 million for the 3 months ended June 30, 2025. After including these adjustments, adjusted gross profit rose from $67 million for the 3 months ended March 31, 2026, to $135 million for the 3 months ended June 30, 2025, but fell to $100 million for the 3 months ended March 31, 2025. The adjusted gross margin also reflects these fluctuations, standing at 9.3% for the March 31, 2026 period, 8.6% for the June 30, 2025 period, and 8.7% for the March 31, 2025 period. After further adjustments including direct selling costs and holding costs on sales, contribution profit shows an increase from $32 million for the 3 months ended March 31, 2026, to $69 million for the 3 months ended June 30, 2025, with $54 million for the 3 months ended March 31, 2025. The contribution margin per home sold, taking into account the number of homes sold, shows a generally stable trend, at 4.4% for the March 31, 2026 period, 4.4% for the June 30, 2025 period, and 4.7% for the March 31, 2025 period. Analyzing these indicators provides a multifaceted view of the company's profitability structure and cost management efficiency, and it is particularly important to analyze the impact of non-recurring items like inventory valuation adjustments on gross profit margins. This slide details the quarterly financial performance for the 3 months ended March 31, 2026. Firstly, looking at revenue under GAAP, we can observe a gradual increasing trend from $720 million for the 3 months ended March 31, 2025, to $736 million for the 3 months ended December 31, 2025, and further to $1,153 million for the 3 months ended March 31, 2026. However, the net loss GAAP shows a different pattern, actually worsening over the same period instead of decreasing. Starting from a loss of $85 million for the 3 months ended March 31, 2025, it significantly expanded to a loss of $1,096 million for the 3 months ended December 31, 2025. This indicates a complex situation where profitability may have improved, but accounting losses have increased. The fluctuations in this net loss are primarily due to various adjustment items such as stock-based compensation, restructuring costs, and gains or losses on extinguishment of debt. Notably, a gain on extinguishment of debt of $933 million for the 3 months ended December 31, 2025, significantly impacted the net loss. Turning to adjusted EBITDA, it began at a loss of $30 million for the 3 months ended March 31, 2025, slightly deteriorated to a loss of $33 million for the 3 months ended September 30, 2025, but then turned positive to a profit of $23 million for the 3 months ended March 31, 2026. The adjusted EBITDA margin also shows significant volatility, improving from -2.6% for the 3 months ended March 31, 2025, to 1.5% for the 3 months ended June 30, 2025, and then worsening again to -4.3% for the 3 months ended March 31, 2026. These movements in financial metrics suggest that not only revenue growth but also the gap between net income and adjusted EBITDA is arising from non-cash expenses and one-time items. Investors should carefully analyze these adjustment items to accurately assess the company's true operational performance and financial health.